gentlemen, thanks for joining us on the Asset Preservation Hour. I'm Brad Johansson with Stuart Willis. Hey, Stu, can we kind of start this off on a long-term premise that I don't know whether it lasts anymore, but it's New Year's resolutions. We go into January is usually good for New Year's resolutions. Even in February, you can kind of hang New Year's resolutions. April, March. I'm not a New Year's resolution guy because I realized I couldn't hang with them. Are you different on that? Do you constantly make New Year's resolutions that you keep with?
You know, it's interesting. I think I try to make resolutions just because it's a reminder that, hey, we need to be there and be present and have some goals to set in mind. And I think that for a lot of people, it really helps. I mean, right now, you know, look, it's been a little bit of time since the New Year's here, and now the gym is emptying out again because January 1st through, you know, the end of January is usually pretty busy, and then right in February it just starts thinning out here. So people start losing track, and I think the thing to think about as it pertains to your money, to your retirement, you just need to refresh those. I think this is a great time to kind of refresh your New Year's resolutions.
So financially, if we go to New Year's resolutions, and I think that's always ever present, you would point to what as to what we need to do at the beginning of the year?
Well, I think number one, just to make it really simple, have a plan. Make sure that you have a real plan, that you have real visibility as to where you are currently and where you want to go in the future. And look, the stage that you're in terms of your own retirement should help dictate that. But I think what's really important to think about when it comes to your plan is to know that your financial plan needs to also include a tax plan. It's not about what you make. It's about what you keep at the end of the day, and taxes need to be a huge part of your financial plan.
Do you like to talk about risk, and sometimes risk will change at year end and going into the next. We're now entering into an election year, and that's significant as to whether things may change. Do we change our appetite for risk at the beginning of the year?
Well, I think people need to know their appetite for risk at the end of the day. And because listen, everybody is bullish during a bull market, and everybody is conservative when the market's crashing. But that's a problem for a couple reasons. People need to understand their real comfort level with risk over time, not over a small period of time, but over the long term, because shifting risk tolerances can be one of the biggest things that lead to a failed retirement.
Can I go back to the end of last year? Because we ran into an August, September, October kind of thing where people got real scared.
Right.
And if you got scared and got out, you may have missed out on November and December.
Right. I mean, look, the market was very underwhelming. I mean, going into October, it was fine because we saw this real roller coaster throughout the year. And, last year, if you saw that, hey, the market's down, for 2 months in a row, 2.5 months in a row, and you got out, you would have missed November and December. And look, at the end of the day, there were a lot of temptations out there to leave the market. And when we look at last year, right, the money market accounts, right? Look, one of our custodians, Charles Schwab, they have a fantastic money market. We have, at the time of airing here, 5.25%. It's a fantastic money market. Which is
tempting for a lot of people. I get 5.25%, I'll take 5.25%.
Right, and so a lot of people did that. But what if you went through September, October, and said, you know what, I'm done. Put me in this money market account, you would have missed this tremendous run in the market. So, there's a saying, it's not about timing the market, it's about time in the market. And timing the market is really a fool's errand. We've seen some pretty advanced algorithm money managers that have really failed over the last couple of years, that have tried to play this timing game. And I really think it's a fool's errand. A lot of people have to understand that, the markets, it's better to be invested, stay invested. But in order to do that, you have to be at a risk level that you're comfortable with over time. So we like to be able to test that out.
Okay, if I'm testing it out, how do I test where my risk is? I mean, I know even personally that I can say, well, I'm risk tolerant. But if I were to actually test myself, I'd find out maybe I'm not really as tolerant as I thought I was.
Well, look, I mean, you look at a great guy like Warren Buffett and like Charlie Munger. We just lost him, another guy from Berkshire Hathaway, fantastic human being, great guys, little old grumpy guys, but love them to death, right? There's some of my heroes in the world of finance. But look, Warren Buffett had always said, don't hire a financial advisor. Just put your money into the S&P 500, let it sit there, and over time you'll do better. The problem with that, you have to understand, Brad, is that if Warren Buffett or Charlie Munger lost 85% of their net worth, they would still be fine. They'd be comfortable. Right? So that's easy to say coming from a position where you can tolerate massive amount of losses. Yeah. But our clients, as they start nearing retirement or they're in retirement, can't tolerate those kind of crazy losses because people know it's way more difficult to get back, to earn it back. Right? And, you know, there's a statistic out there, and I think it's pretty interesting. If you look from the years 2003 to 2022, the S&P 500 did tremendously well, right? In fact, you know what I'm going to do? I'm going to pull up a slide for you. It's the S&P 500. And if you take a look at that, we're hitting that second peak as we speak. Okay. And over time, never forget that going into retirement, if you look at the slide here, that first hump on the left, that was the dot-com crash. Well, if you take a look, it doesn't break even from 2000 there until 2012. It took 12 years for the market to get back. So I think, Brad, oftentimes what we're seeing is that a lot of people are entering retirement after one of the greatest stock markets in history, thinking that they're always going to make 10 or 12% on their money, and it's just not always the case. And some people have to look at that and say, hey, we refer to that as the lost decade. It's possible that your market can go up and down and up and down. And you saw the recent graphic. It looks like we're heading in that way again, right? We're on that first hump there, or the second hump. But I have another graphic I want to pull up. It's called Timing the Market.
Timing the Market, all right.
And what this does is it tests what we're talking about with Warren Buffett. So if you put $100,000 into the market from 2003 to the end of 2022, that $100,000, if you left it invested undisturbed, would turn into $647,854. Right? Pretty nice return, right?
Significant, yeah.
Well, here's the thing. If you just missed the best 5 days in that 20-year period of time, look at what the next slide will show you here. You only have 409,182.
You missed 5 days in that time?
If you miss 10 days, you have less than half of the return of the total S&P 500. And Brad, let me impress this upon you here. Okay, understand that we're talking about 10 days for less than half of the return of the market over 20 years, over 7,000 days.
10 days in 20 years.
20 years. That's 1 day. If you miss 1 day every 2 years, the good days, and here's the thing. Well, people say, well, why don't we just invest in the good days? Listen, if I knew when the good days were happening, I wouldn't be here hanging out with you guys. I'd be on my 500-foot yacht in the south of France somewhere.
Yeah.
But at the end of the day, nobody knows when those good days are coming or when those bad days are coming, which is why you have to be comfortable over time. And for people to be comfortable, they have to be at the right risk level for them, not the right risk level for their friends. Stop listening to your friends at the water cooler. Make sure you're invested in a portfolio that's right for you. That's diversified, that's in the right place for you. Stop listening to your friends.
Well, this is kind of what you talk about, that you have said this many times, that your losses over those 20 years are going to hurt you much more than your gains are going to help you, because you can't time it right.
Well, listen, nobody is perfect at timing it. And, you know, I think what happened is from 2009 to the end of 2021, the market did unbelievably well. And it gave individual investors this false sense of confidence that they were doing well. And just remember, a blind chicken could have made money during that period of time. Everybody made money. You didn't have to be special to do it. And I think that most people are completely lost with how much risk they're actually taking inside that portfolio. So what we're going to do today is, for the first 10 callers, what we're offering is a complimentary, absolutely free portfolio review, where we will assess what kind of risk you're actually taking inside your portfolio. We use a couple great softwares here. We look at Morningstar. We have this great program called Nitrogen that looks at it from a couple different angles, because most people have no clue how much risk they're taking. We'll also take a look at how much fees you're paying inside your portfolio. If you're concerned that you're taking too much risk, inside your portfolio, or you have no idea how much risk at all that you're taking, give us a call at 844-503-PLAN. That's 844-503-7526. Or even easier, if you pick up your phone, click on that QR code, take action. Make it your New Year's resolution to find out how much risk you're actually taking.
We have a lot of DIY folks out there. I can do this myself. It's kind of what I said before. When I thought I was assessing my risk before taking a test, the Morningstar or the nitrogen, how is this actually going to help somebody find out something that they thought they already knew about their risk?
Well, I'll tell you this, people have no clue how much risk they're actually taking, because what we do is we take your existing portfolio and we test it against historical events. So for the 2008, 2009 financial crisis or the dot-com crash, we test it against those events. Or even 2022, where we saw not only the stock market dropping, but the bond market dropping as well. Conservative people got hit even harder than aggressive people over the last couple years. So you need to know what kind of risk you're taking so that you can plan your perfect retirement.
All right. Have you made any New Year's resolutions? Maybe just to figure something out that you hadn't figured out before? And certainly your financial plan should be at the top of that New Year's resolution list. How about a free risk analysis? Do you know what your tolerance is at this point? Let us help you. And it's free. I'd say that's a great New Year's resolution for you. Call the number on your screen, 844-503-PLAN, 503-7526, and get your free risk analysis. Now, when we come back, I'm going to talk about some of the options available to retirees, how to know whether or not you are properly diversified. As we go beyond risk, stay with us. We'll be right back.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Stuart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
Glad you're with us on the Asset Preservation Hour with Stuart Willis. I'm Brad Johansson. We left talking about what some of the options may be if you are nearing retirement or new retirees. Let's start in some of the options there, because everybody likes to have options. If we do have some of those in these years, what would you lead with?
I think, first of all, people just need to know what their options are, right? Be aware of what the full, availability of options are inside your retirement plan. But one of them that I think most people don't understand, Brad, is that when they turn 59 and a half, oftentimes they have the availability to take their 401k, roll that into an IRA, and have their money properly managed professionally. Because look, I think people have gotten concerned that, the markets have been tumultuous. Sure. They've seen all of this volatility in 22. It was a mess. 23 was kind of all over the place. Conservative people tended to get hit harder. And when I say conservative people, I'm not talking about politics. I'm talking about your ability to lose money, right? Well, if you turn 59 and a half, it's very likely that your thrift savings plan or your 401k or your deferred compensation plan allows you to take that money out and not quit your work, be able to roll it into an IRA and have it managed by a third-party professional money manager. Now, there's some downsides to it that you really want to understand. You want to make sure you get a second opinion. We'd be glad to give you that second opinion, but you want to understand that there's some reasons to do that.
All right, so analysis free for obviously what we were talking about in risk, and now analysis for trying to figure out option-wise what we should do as we go to 59 and a half and there are different ones.
Yeah, absolutely. And I think at the end of the day, one of the big reasons people want to make sure that their money is overseen by a professional is that they're they're invested, very, very casually in a way where they look back and they say, okay, well, this fund did well last year, this fund did well the year before. And they end up putting their money into funds that are oftentimes overlapped, meaning they're not diversified at all.
Well, they thought they were diversified. But when you say overlapping, some of them were the same things?
Yeah, because oftentimes when you invest your money and you buy 5 different mutual funds, it's very likely that a lot of those mutual funds are invested in the same exact underlying stocks. So you want to make sure that each of those things do different deals. And just remember, when we talk about diversification of investments is where it begins. That means to make sure that each investment that's inside your portfolio has a different role, that they don't all do the same exact thing. Because if they all own the same stocks, let's say some great stocks like Apple or Facebook or whatever, Google, if they all own the same underlying stocks, then they would move identically in the market, up, down, left, right, etc. If they all do the same thing, then in our opinion, they're not diversified. They can be very highly correlated. So the diversification of investments is where it begins.
And some of the times we will make those investments maybe based on how we see the world. You said, I'm not talking politically, but for a lot of us, the way we see things politically or the way we see the world may affect how we put our money, and that's probably something we need to look at.
It is, absolutely. Look, I mean, Portland is politically is a pretty left-leaning city here, and having said that, it tends to affect the way people invest their money. Sometimes for the better, sometimes for the worse, right? Look, I think that your voice and your money are very intertwined here, right? So use your money how you believe you should. You should never be supporting things that you don't believe in. I think it's important to voice your First Amendment right inside your portfolio. But I think it's also really important to make sure that when you invest your money, that you have a diversification of perspectives, multiple points of view inside your portfolio. And the reason I say this is oftentimes a financial advisor is the one picking your funds for you. And they'll look at it and they'll say, hey, you know what? I really like this stock. I like this bond. I think we should have this mutual fund inside there, this ETF, whatever. Now, what if that advisor's wrong? You're going to bet your whole life savings that one human being is correct? I think it's a huge gamble. And look, we've been in business now 26 years at Asset Preservation. We've been in business a long time. And the one absolute truth we know is that no matter how smart you are, no matter how smart your financial advisor is, they're not going to get it right all the time. Even if you're a self-investor and you say, hey, look, I made all this money for the last 20 years. Well, that's right. Everyone made a lot of money because the market did well. The question is, during the tumultuous times, how did you do? How did your advisor do, et cetera? And that's why we think it's important to have multiple points of view reflected in your portfolio.
Fair enough. You constantly talk about taxes, and I want to know how this kind of plays into that diversification game as we move forward.
So we've talked about 2 different things when it comes to diversification. A diversification of your investments, meaning things that don't all move together in the same direction. A diversification of perspectives, multiple points of view inside your portfolio. But we also believe you need to have a diversification of tax classes. So oftentimes, a lot of people, all of their life savings is put into their 401k or their thrift savings plan. And, you were told your whole life that, if you put your money away into your IRA or 401k, that when you retire, your income will be lower. And so when you take it out in retirement, that, you'll be able to pull it out at a lower tax rate. That may or may not be true. We're in a really interesting time from a tax perspective now. And I think just to put into perspective, there's something called the Tax Cut and Jobs Act that came in place in 2017. And the Tax Cut and Jobs Act is interesting. We are in a very, very efficient tax window right now. And look, this is not a political position. It's just a tax position. efficient, okay? We're in one of the most efficient tax windows in history for the middle class. So people that are between the 12 and the 24% tax bracket are in this incredible discount window, and it goes away at the end of 2025. Now, I've got a slide, a tax slide that I want to show you here to put into perspective. If you take a look, we are currently in the red tax brackets right now. And the blue is what they used to be before the Tax Cut and Jobs Act. Well, here's the thing to think about, that these red brackets are going back to blue at the end of 2025. So we have 2 years left, including this year, to take advantage of these low tax rates.
Unless something changes, which is what we always say, because this is the end of it at 2025. But what we know about the government for sure, they can change things whenever they want.
Yeah, absolutely. And so what we're talking about here is the fact that we don't know where they're going. The likelihood of them extending the tax cuts, I think, is very unlikely. So for people, that are in the lower brackets, that 10, 12, 22, 24% bracket, those are the people that really need to take advantage of where we are. Because look, when those taxes were cut in 2017, and I don't care if you're a fan of Donald Trump or if you hate Donald Trump, I'm not making a political position here. What I'm saying is that we are in this efficient window for those kind of lower income to middle income folks, all the way up to $300,000 a year. And so you have time to take advantage of it. And the way you would do that is by doing something like a Roth conversion, by taking your existing IRAs and 401ks and paying the taxes now in a controlled environment so that you can diffuse that tax time bomb that you've been building up for all these years. Because what I said before is that it was a faulty premise when you were told that your tax brackets were going to be lower in retirement. And even if you make less income in retirement, what a lot of people never thought about is that they never thought about the fact that when you start pulling this money out in retirement, that now you're potentially making your Social Security taxable when it was never meant to be taxable. Because remember, Brad, we were told that by Franklin Roosevelt that the Social Security would never be a revenue source for taxation.
Until they decided to change it.
Yeah, and believe it or not, it was a Republican that made it taxable for the first time, right? Ronald Reagan in 1983 allowed Social Security to be taxable for the first time. And then Bill Clinton in 1993 made it more taxable. So up to 85% of your Social Security benefit can be taxable as ordinary income. And what determines that is something called provisional income. It's a calculation that just looks at all of your taxable income, even your tax-free municipal bonds. You add that to 50% of your Social Security benefit. And if you have more than $44,000 as a couple of provisional income, then 85% of your Social Security is taxable. And it's crazy because I don't think people understand the magnitude of Social Security, right? The average person that comes into our office has between $1 million to $2.5 million as a couple over their actuarial lifetimes. So people come into our office to do our absolutely free portfolio reviews. And look, they've put away $500,000, $1 million, $2 million into their retirement plans. And they want to talk about that. Well, first, we want to talk about that $1 million to $2.5 million of Social Security, when you should be taking it, from a timing perspective, but also what is it going to look like when you start taking money out of your investments, right? Your 401k, your thrift savings plan, your IRA, because now you're going to start making that money taxable when it may not need to be. It may not need to be. Every situation's different, but it's important not just to have a financial plan, but to have a tax plan as well. And so what really scares me is when Lindsey Graham and Bernie Sanders agree on something.
You like to talk about this guy.
Right?
Yeah.
Well, at the end of the day, what they agree on is that higher income folks don't need Social Security as bad.
Yeah.
Right? Even Chris Christie, who had less than 1% of the Republican vote, in one of the Republican primaries, he even said it, that, hey, Warren Buffett doesn't need Social Security, which I think most people agree. He doesn't need it, right? But to me, that's a dog whistle to say they're coming after it more. So when both parties tend to agree that higher income folks don't need Social Security as much, what that's saying is the people that have put their money into their IRAs, their 401ks, their thrift savings plan, or 403bs, those are the people, when you start taking the money out of there, those are the people that are going to get penalized the most because they didn't think about the taxes on the way out. They've built these massive tax time bombs, and it's going to come back to haunt them at the end of the day. day.
Here's what is concerning, because you're trying to say, now's the time. No one wants to deal with taxes right now. There are very few people who believe that in 2025, at the end of 2025, that the number is going to go down. How can you believe it's going to go down when you're $34 trillion in debt? What are they going to do? They have to pay it off with taxes. And if you don't take advantage of this window, it may be gone forever.
Yeah, people are going to be looking back and saying, I wish I would have taken advantage of the most efficient tax window in history. And at the end of the day, I think it's a big concern that people aren't doing that. You know, I think people really need to make sure they have a tax plan, because look, at the end of the day, you know, we've seen clients come into our office, and we have a full service tax office. So we did about 1,200 tax returns last year between our Arizona offices, our Portland, Las Vegas, and Denver. And, you know, it was a lot of tax returns. But the purpose of our tax office isn't about tax preparation. It's about tax planning. And what we see all the time is people that have stocked up all this money. They've amassed these nest eggs. They put money away, but then they become afraid to actually use their money, because they realize that when they start taking money out of their 401ks or their IRAs,
taxes.
Guess what? Uncle Sam now wants a piece of their Social Security from a tax perspective, even though we were told the whole time it would never be taxable. And at the end of the day, we're talking about a huge benefit of Social Security. So when we talk about diversification of investments, we talk about a diversification of perspectives, diversification of tax classes. We also want to talk about having a diversification of strategies. And by that we mean, don't have all your eggs in one basket. At Asset Preservation, what we do differently is it's not just me picking funds for my clients. It's not my advisors. We have some of the biggest and best money managers in the world that have different strategies. We have, you know, one of the biggest in the world, BlackRock, fantastic money manager. We have David Young from Newport Beach. We have our strategic portfolios. We have our algorithm portfolios. And as brilliant as all of them are, guess what? They are not right all the time, which is why you need to understand whether you're truly diversified. Because if you saw a tremendous amount of loss over the last couple of years, or maybe you didn't see the gains that you should have expected, maybe you missed out on some opportunity out there because you relied on one human being to make sure that you were, you know, going to be secure in retirement. That's a tremendous risk. And I encourage you to take advantage of our free portfolio review. And we're offering that now to the first 15 callers. If you give us a call at 844-503-PLAN, that's 844-503-7526, or even easier, pick up your phone, make it your New Year's resolution to click on that QR code. It'll take you to the website, to assetpreservation.com. Ask for your free portfolio review. If you claim that review, make it your New Year's resolution to take advantage of your perfect retirement plan.
Want to do something that's best for you? Now's the time to make that resolution to get that free plan. Call the number on your screen, 844-503-7526. As always, we thank you so much for joining us. We'll see you next time.